This is Trepp with a special guest podcast with a focus on liquidity and CRE. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. And joining us today is James Shevlin, President and COO at CWCapital Commercial Real Estate Investment Services and RealINSIGHT. Welcome, Jim. We're going to call you Jim from here forth.
That sounds good.
Please share with our listeners a brief background about yourself and your firm.
All right. Well, good afternoon. Thanks for having me today. I joined CW Capital in 2016. Actually, my 5-year anniversary was on Monday. So I'm a veteran now. I had spent the previous 10 years at a firm called American Capital, really on the bond acquisition side. And we had hired CW Capital as our special servicer. CW acquired our bond book in 2016, and then it was a natural fit for me really to join the firm. For people that don't know, CW was organized in 2002, and since 2010 has been owned by two funds of Fortress Investment Group. We've been primarily known as a CMBS special servicer, but we're working really hard to expand beyond that. When I first joined, one of the first tasks was to develop and enhance our technology platforms. And first up was addressing our disposition strategies, which really led to the development of Marketplace in 2017. Since that time, it's been very successful. We've sold over $3 billion of a variety of commercial real estate. And then I also spent time promoting our RealINSIGHT technology platform, which is now licensed to over 30 clients, providing full life cycle support on origination, securitization, underwriting, surveillance, asset management, and servicing. So handling a little bit of everything. I became president in 2018, running the day-to-day operations for CW. But as you can imagine, 2020 was like no other time, and very difficult to manage a company through the last 12 months, especially a special servicer who saw tremendous growth, over the last 12 months. COVID started, I always say, oh, this is going to be 30, 60, 90 days at most. Well, I have to tell you, that was probably one of the worst predictions I've ever made. And, immediately just immediate impact that we saw.
So, Jim, before we get to some of the market specific and, CRE specific questions, you spent a lot of the last couple of years transitioning the firm to be more technologically oriented. As you mentioned, you have the platform, you have the auction service, if you will. What has COVID done to your momentum there? Has it made it easier to get people to adopt the auction process, or has it slowed you down at all?
Actually, it's all our technology has really blossomed during COVID, and somewhat unexpected, I would say. I think on the marketplace side, everyone working from home, access to the internet, they were very easily able to log on, maybe put their other work aside, and we're looking to see what assets we were selling. In 2020, we saw a lot of smaller deals, which would make sense, meaning that 5 million and below, people were able to pay cash for those deals, and we saw more registered users per deal, more volume, and we had a record year for Marketplace. On the RealINSIGHT technology side, which was interesting, people started paying attention more to their portfolios. Everything was performing well. And then all of a sudden, things screeched to a halt. And they're like, what do we have in this bond book? So one of the main things that the technology platform does is surveillance and data management. And there was such a great need for it. And we added 9 new clients in 2020 and have already added 4 new clients in 2021.
So thanks, Jim, first of all, for coming on. Nice to meet you. You talked about managing a company during COVID, and then just the double whammy of managing a company that also has to manage all the specialty service assets, which ballooned in 2020. Give me a vibe check on CWCapital and kind of how, you send everybody to work from home and also, quintuple their workload. How'd you guys handle that? And we're
Just crazy, right? We started 2020, our special service named book was 126 billion. What was in actual special servicing was about $1 billion. Now we look really smart, but we took the position in 2018 and 2019 to sell as much legacy as we could, legacy CMBS assets. So those were deals that originated 2005, 6, 7, 8. Markets were great. And as a special servicer, you never want to look bad, right? And you may not hit a home run, but if you hit a double or a triple, it's a good thing. So we did, and we successfully sold billions of dollars worth of real estate. And then, things come into special servicing for a variety of reasons. And we were going to manage a book of about $1 billion. Quickly, our $1 billion book went to $6 billion. We had 500, almost 600 relief requests for $18 billion come through with a staff that was really right sized for $1 billion portfolio. So then we had to go out and hire a bunch of people, and people with a lot of hospitality experience, because that was the initial need. We're lucky to be in DC, where we've got Marriott, Hilton, Choice headquartered here, and a lot of hospitality REITs, and they were downsizing. We were able to pick up some fantastic people, and they're managing the assets today.
Let's get into the liquidity conversation. It's estimated that $250 billion is waiting to be deployed in CRE. What are you seeing in terms of liquidity and transaction volume?
The market is just flush with cash, and it's leading to not only aggressive pricing on dispositions, but on bond acquisitions, on rescue capital. People are just looking to deploy the money any way they can. What really hasn't been as robust is lending. I think leverage is very disciplined right now. There is some aggressiveness in lending, but it's really on the more attractive quality deals. That's just a little piece of the pie. There's a lot of deals. You're below 5 million right now on a hotel. There's not much lending going on besides the SBA for those deals. When you get above $15 million, there's bridge lenders and everyone else attracted those deals. But those deals from 5 to say 15, there is not much interest. And it's probably due to it's too big for an SBA loan, and it's too small for your typical lender because they can't make enough money off those deals.
So Jim, this is not your first Category 5 hurricane, as somebody who's been in the CRE business for some time. You already mentioned there's a lot of liquidity right now. We know that after the great financial crisis, there was very little liquidity at the time. What can you tell us is similar, now to the great financial crisis, and what is different? What makes this one new?
Well, I think you hit it on the head. That, from the, let's say, round one crisis, and I've been through many crises. 1998 Russian ruble. I worked at RTC for a little bit. The 2005 to 2008 crisis that we saw, there was little liquidity, and cash was king at that point. And the groups that were able to take advantage and buy those assets or take down bonds during that time did very, very well. I think what has surprised me though is values have held up in this crisis compared to the other crisis too. We are seeing, the appraisals coming in very strong. And the big difference, as you may know, between legacy CMBS and 2.0 CMBS is realized versus unrealized losses. So an appraisal could have an effect on your bond class. And if you get something that's not to your liking, you're taking that loss versus in round one, it was based on a disposition and actual loss. So that's a huge difference between the two crises.
I mean, certainly there's a lot more discipline going ahead of this crisis in the lending market, right? We didn't see that same type of extraordinary leverage that we saw in 2006 and 2007, inflated appraisals and so forth, which I think is bailing out the market right now. The fact that it was disciplined really from 2012 to 2019.
You're absolutely right. When in 2005 to 8, 80% leverage with mezz behind it was not atypical. And today, it was probably 60 to 65. So even if the appraisal comes in 20% below, you should still be value good. Cash flow may not be there, but value is still good. And that'll keep the deal afloat. In 2005 to 8, those values didn't come back for a while. Mm-hmm. And then, as you know, there's advancing that goes on to pay taxes, insurance, or payroll or whatever, and you just never recover.
Jim, you mentioned, it's kind of diverting back a little bit for a second here. You mentioned hotels, obviously, that's the big driver of special servicing volumes. And you also mentioned you got, relief requests and forbearance requests. Yeah. I don't know how much detail you can go into or not go into, but just can you give us kind of a high level overview of the thought process for any given special servicer in that situation? You get a relief request, and then what? And then kind of, I would say, we've been talking about the forbearances that we've seen and based on what we see in the special servicer comments and the modification templates and stuff like that. But maybe just kind of what's the CWCapital plain vanilla forbearance that you guys were seeing in the hotel space? Sure.
Well, one thing I want to point out, which is interesting, prior to COVID, so January through March of 2020, we started seeing limit service hotels transfer into special servicing. And it was just out of the blue. And I think that once COVID hit, it just further put a spotlight on hotels, and the deals that weren't going to perform definitely didn't perform during COVID. So we get all these requests in. What do you do with them? Some have legitimate issues that needed to be addressed. Some were just fishing for relief and they were denied. And, a forbearance is a modification. So it's a pretty serious thing when you're modifying these securitized docs. And I think the hotel franchises did a great service to the community by allowing us to tap into the replacement reserve accounts, to use that to fund, expenses. And we allowed 90 days or whatever the request was. Some went on longer. There were multiple rounds of forbearances, but we did develop a standard forbearance package, which was easily documented. And as long as they proved to us that it was a need, we allowed it. Now, when they came in for round 2 and 3, it got a little bit tougher conversation. Did we see a light at the end of the tunnel, or what were they going to bring to the table? And we continue to have those conversations, with those borrowers, because it does become a point where if they're not willing to bring money to the table, we may be better off putting a receiver in place and then taking whatever remedies we need to take, foreclosure or some kind of note sale or some other disposition method. But I think hospitality, it's kind of a tale of two cities, right? Leisure has come back very, very quickly. Those properties are thriving, definitely performing better than the start of COVID. We are still seeing a world of pain in convention, group, business traveler related. That's that, Monday through Thursday business, which just is not there. And I don't see the light at the end of the tunnel for that. We're lucky if we get into 2022 on that. If those events are planned out a lot further in advance, and you guys probably see, no one's traveling right now. I mean, unless you have to travel, no one's planning a convention or a group event. Everyone's doing it virtually. And will we see a total shift in that? That may be something that happens. Running a company, you do watch the bottom line, and when you don't see those expenses coming through, but you're seeing the business activity happening, you start to question, what's necessary and what's not necessary.
So let's talk about office. Everyone's debating what's going to happen in office. Are the footprints shrinking? Is there a hub and spoke model in the works for many companies? What are your thoughts on that?
You know what? Office is a big, big mystery right now. No one can tell you what's going to happen. You know, we hear a lot about this hub and spoke. I don't see that just yet. The anxiety surrounding office is, I don't know if it's fake or if it's real, because I look at our statistics and, you know, I pulled our March and April non-specialty service delinquencies just to take a look. And our office delinquency is almost non-existent. It's like 50 basis points. And there's always going to be some that, and that's 30 days or less. So there's always going to be some delinquency when you have a $200 billion portfolio. So it's just non-existent. And I think, you know, compared to hospitality is a one-day lease, right? Where office is longer-term leases. And you realize you have to have an office, no matter what company you are. You have to have somewhere where mail to go. You have to print checks or do your accounting services or whatever activity you do. Where hotels, you don't really need that. And that's why we really went real quick there. But I do wonder what's going to happen. And as leases mature, what happens to space needs? What happens to rent? What happens to your TI allowances, et cetera? So I look at CW as actually a pretty good example of this. Our lease matured for our headquarters space in December 2020. So we started during the COVID period, you know, looking for new space. And crazy as we may be, we moved our headquarters from Bethesda to DC to, you know, take a variety of reasons, more centrally located, but we also were able to take advantage of what was happening in the market. Good TI packages. I think the rent was definitely fair for what we signed up for on our term. I think we were able to design space that took into consideration all the COVID parameters that are floating out there, even though they're changing all the time. Developing more flexible space where we, you know, I'm not personally a huge fan of work from home, but I think I have to become a fan of work from home. And I know that, you know, I look out there right now, there's probably 10% of our people here, and I think that's a pretty standard average across the states. It's hard to get people to come back to the office. So you're going to have to offer them a hybrid model to start, where they get to work at home a few days, come to the office a few days. I'm hoping by September, Labor Day, that we can have everyone back full time. But I do think there's a big shift. And I think that shift, then companies are going to start to say, well, how much space do we really need? We went from 23,000 to 17,000 feet. And we're able to do so because I'm not going to give a seat to everyone that's going to want a flexible schedule. So they're going to sit in an area and have a locker and then move things in and out when they're here. You know, right now it's 10% probably occupancy. Will it go up? Yes. But will it go back to 100%? I doubt it.
Jim, I think that for me personally, if we can do a hybrid model where the days when I'm not working in the office, I don't have to be on Zoom. I'd commute like 8 hours to the office for a couple days a week, just so that I didn't have to be on Zoom for 12 hours a day. Yeah. Otherwise, normal listeners will know I rail against Zoom all the time. But the one last thing I'll say, and then I'll let Manus jump in, is, you know, you reduced your office space by around 20% or so, just based on those numbers you just threw out there.
Right.
You know, in my mind, that calculus and math is going on in every single CFO and COO's brain right now. And you said it, we see it in our numbers as well, right? Across the whole CMBS universe, the office delinquency rate is fairly low and didn't really have any noticeable uptick during COVID. But over the next 5 years, as every CFO and COO has that same math play out in their head when their leases renew, if you do see a reduction in space by 10 or 15 or 20% across the board, you know, then you have to take into account all the new firms that start up and have to take on space and all that type of stuff. But I'm just thinking that that's kind of the slow burn anxiety.
And right? where are people going to want to be located too? And that is the other thing. You know, right now, I think one of the concerns people have returning to the office, especially in DC, New York, some of the major cities, is public transportation. and the fear of going on a subway to get to work. So are people going to want to drive to the suburban location instead? Maybe, but as a company, you want to be centrally located. That's how you attract the best talent. I don't know. I think that's another big debate out there. And I think that gets the whole hub and spoke system where you create these small pocket offices out there.
I think that one of the things that people haven't made the connection to, and I'm interested in your point of view here, is how much that office evolution and how it lands, 3 to 5 years from now, will impact lodging in business-centric cities, right? The typical model of the management consultant getting on a plane in New York, flying to Charlotte or flying to Detroit, sitting down in front of a room of 8 people and going through their pitch. If only 3 of those people are going to be there on a given day and you're doing a Zoom anyway, I don't think the consultant gets on the plane in the first place, right? So I think that's one of the things. I think everybody is in agreement with you that the leisure destination hotel just really takes off. But I do think that business-centric hotel is really tethered to what percentage of the office is back in the office. And that could really be a thorn in the side of the market going forward.
It's going to be a while to get there. And the other thing that, with office that we haven't talked about is the WeWork type space. And we specifically located in a building that had pod space so that if we needed to expand, we could easily just not take on more space, but we could add it easily. Will that take off during this as people may work from home or need a conference room or some support to help them get through the day? That may be a beneficiary of all this too.
Let's look at retail, because that's an area also that during COVID, we had really 2 different stories going on. Essential retail was doing well, relatively speaking, and e-commerce took off in ways that many people agree it was an accelerated pace. So where does it end up after the pandemic?
Well, surprisingly, in the beginning of COVID, we got a ton of requests for retail relief. Tenants weren't open and they weren't paying. So the dry cleaner or the fitness studio or the dentist office that happened to be in there, the only thing that was open was the grocery store. And as you know, sometimes they're a great tenant to have as an anchor, but they typically don't pay the rent that you need compared to all the other little tenants that pay a much higher rent. So the government, I think, did a really good job. This is where the government stimulus really helped retail get through a lot of the hurdles of COVID. And we quickly saw our retail book go from non-performing to performing with the government stimulus. And to this day, our retail delinquency is really non-existent too. It's very low, not as good as office, but still pretty low. I do think, the elephant in the room with retail is malls, and it's been a further decline, in performance. We have malls throughout the country in our book. We have the largest mall in special servicing right now, creating modifications to help them get through non-opening of tenants. It's still concerning that how do we replace some of these big box retailers? When Macy's or JCPenney's or Sears shuts down, what do we do with it? And it's very creative uses that will hopefully get us through the problems. I mean, it's a total shift. It's a total shift for malls.
Yesterday on an interview on CNBC, the CEO of Simon was saying that, the consumer for the mall space is becoming euphoric, right? He wants to get out. He wants to shop again. Of course, Simon is going to talk their book a little bit. And of course, they own some of the best malls in the country. So that leads to my next question, which is, are you seeing a big differentiation between the high level malls and the B's and C's in your book?
Yeah, I mean, I would say yes. The A malls, the same store sales are improving. Better operators control a lot of tenants and some of the REA restrictions, and they're able to do what they need to do to make it work. The BC malls probably should have been shut down prior. We could stick an Amazon distribution center in some of those. Things will do well. It used to be the movie theater would take over for the big box. Now that's proven to be, Not a great answer. But the one thing about malls we all agree with is very well located, a ton of parking, easily accessible. So there should be some other alternative use to it, but will that use allow you to maintain your debt service? That's the problem. And it costs a lot of money to re-tenant these things.
So I'll ask a little bit of an inside baseball question here. I was reading an article this week that at the Lewiston Mall, they've allowed a new tenant that is an axe throwing operator. Now, is this something as a special servicer you would advise? Would you sign off on that lease for axe throwing?
Well, let's check
How many
the insurance
14-year-olds
policy
Right
first.
next to the charter school. K-8.
That's right, with the senior living facility next door. I don't know. Axe throwing in a bar probably aren't a great combination.
All right.
But how do we fill that 200,000 square foot box? And that's a pretty large facility.
Well, you did already talk a little bit about multifamily, but one final point on that, with all the attention on single family homes and lack of inventory, rising prices, are we going to see that carry over into the multifamily space?
We have our multifamily book is about 160 billion. The deals that are in special servicing, I can count on my two hands. It's just non-existent in terms of defaults. The demand for housing is still very, very high, whether it be single family or multifamily, but there's still some concerns to watch out for here. One is what happens when the eviction moratoriums are lifted. We do see a lot of smaller balance properties struggling. They're making their debt service, but they're struggling to evict tenants. We'll see if that's resolved over the summer. I think the other thing that's going to happen too is on leasing, what do you do when you have a potential tenant with a rough credit history? And I think you're going to see a lot of that coming post-COVID.
So Jim, based on, kind of what you've said so far and my understanding, over the years, I've watched, at CREFC and other conferences, I've seen your guys' booths and, we have some cross-pollination of old salespeople too. I wonder if we'll get a shout out from them at podcast@trepp.com email. It's kind of an interesting move and something that you see in a lot of other industries. I mean, Amazon took all their server space that they weren't using and turned it into AWS on a much smaller scale. You guys took your, infrastructure that you use to do your day-to-day business and kind of productized it. I guess there's like so many questions in my head as a product guy in the software and tech space, but kind of walk us through like how that decision came about. And then also, all these new clients that you're bringing on, are you finding them happy with the infrastructure and software, or is it much more kind of bespoke implementation type stuff? And you could go into as much or as little detail as you want on that.
Sure. So kind of separated the two, marketplace on one side and then the real estate technology on the other side. But on marketplace, it's really a natural fit for us to really control the disposition of these assets. We were using another online auction platform, and we felt that it was getting stale, and we were seeing similar buyers, and we wanted to kind of expand beyond that. Online dispositions are here to stay. They've really only been around for commercial real estate about 10 years now. And it's really revolutionized how you sell a property. When you're able to have your buyers do all their due diligence up front, get them to register, bid, sign a contract within 2 hours after winning, and then posting a deposit after 24 hours, and then closing quickly. I mean, that whole certainty just benefits the buyer, the seller, and all parties involved. And I think in the beginning, the old brokerage community was very hesitant to online sales. And I think now everyone has realized this is the way to go. And we're pretty excited to be positioned where we are in the space and the growth that we're seeing there. So that if anyone's interested, they can check out our site of rimarketplace.com and can take a look at all the auction events we have scheduled coming up here. To date, I think we've sold 50 deals plus this year, and a bunch others that are under contract. So it's been a pretty good year. On the technology side, we just continue to really expand our offerings on what we do there. And that's really based upon need from the clients. RealINSIGHT technology started out as really a database management used for surveillance, and that's really what it's known for. But we've expanded beyond that into origination and now into servicing. We're excited kind of to see where it goes, and as the demand dictates, we'll develop that additional product. And there is a huge need out there. I mean, we have, as a special servicer, we have just a ton of data and a ton of information, and we've never really taken advantage of that. And we're starting to do that and taking that data and sharing it as best we can with our users.
Going back to your website, the RealINSIGHT marketplace for our listeners, very easy to use, and you could see what's out there for sale, not behind a paywall. So for those that are interested in looking to see what's out there, I go there once a week just to see what's up for bid and so forth. I find it very useful.
Have you bought anything yet? You got to click.
I got to talk to management, and I need them to finance me.
You need a bankroll.
We have lots of clients, though, who are constantly looking for that stuff. So that's
absolutely.
Well, that just ties to your liquidity question earlier. There's just plenty, there's assets out there to everyone's liking. You can go from a small little dollar auction that we have, absolute auction, up to we've had a $100 million office complex on there. So it runs the gamut.
All right, Jim, let me ask, before we sign off, let me ask you a controversial question here.
Uh-oh.
So during COVID, you said there's tons of cash, right? We totally agree with that. We have lots of clients who have come in who were clients before or who had signed up over the last year looking to take advantage of distress, right? A year later, here we are, a year and a half later, a year and 2 months, whatever it is. And the narrative is the distress never materialized. Is that your fault, Jim?
I mean, we did too good of a job.
You did too good of a job, or you've been much more, let's say, like last time, it was a much different story last time around, right? There was much less liquidity and much less flexibility. But I guess what I'm saying is, will there be, an opportunity for the distressed asset buyer this time around? Or is there just way too much, free money and flexibility from lenders, for there to be significant volume there?
I mean, there will be. I mean, two of the kind of the pending issues that people should be thinking about in terms of CMBS are maturity. And there will be the next maturity wave will start in 2022 and continue on 23, 24 from those deals that originated in 2012, 2013, 2014. So there will be opportunity there. Where rates are in a year or two, who knows? I mean, things seem stable now, but that could change fairly quickly. And then there could be problems with that. Rescue Capital has come into a lot of our larger deals and has right-sided, what they need to do. But as you know, with Rescue Capital, it's typically fairly expensive. And if things start to go the wrong way, they're quickly hopping in and taking control. And then who knows where those deals go. But I think some of the issue is, the controlling classes are somewhat hesitant to sell assets right now, knowing that the capital markets are a little bit questionable. And if they want to maximize their pricing, they may wait a little bit and stay on the sidelines. But eventually it will come. People just need to just relax a little bit. I think they've raised all this money. And it's hard to raise money. But once you raise it, you've got to put the money out the door.
Yeah.
And if you don't put it out the door, then you can't really raise it again. But maybe they raise it too quickly.
Well, to Joe's point, there may be some disappointed, distressed asset buyers out there with cash, but I think there's an awful lot of pretty happy controlling classes that are pretty grateful that Jim's getting good execution on what he is disposing of. So it's two sides to that coin for sure.
Thanks. Yeah, I would agree.
And with that, we'll close this special podcast. Thank you to Jim Shevlin from CW Capital. And thanks to our producer, Haley Keene. Join us later this week as we look at what's happened during the week and how it may be impacting you. If you have a question, send us an email to podcast@trepp.com and visit trepp.com for more info and subscribe to the podcast with your favorite provider. Thank you for listening and stay well.
All right.